Welcome back to another episode of the Lone Star Capital Podcast. Craig McGrouther here, the Director of Business Development, alongside co-founder, principal, Rob Beardsley. How are you today?
I'm good. I'm a little underslept. I've been breaking my no phone in bed habit, so that has been it's good for me studying Russian before bed, but not been good for my actual sleep. So
Right.
that's where we are.
Hey, did you run into Patrick Carroll today? I saw he was outside of your building.
I know that's really, really funny, but unfortunately, most listeners are not going to understand how truly bizarre that is.
Yeah. Well, if Patrick Carroll would come on the show, we would welcome it. And I think we have some merch coming our way, which we are excited to wear. But let's get into just some housekeeping. I'm going to filibuster here for just a brief moment. So don't mind if I don't mind. Of course, we have our newest deal, Grand Riviera, which is live. The webinar should be out for you to watch to go through any of that information. This is a 506C opportunity. At the moment today, we still have a bit of space left for any capital allocators looking to find an opportunity to work with, to find a sponsor and a place for a client's capital to go to. This is a great opportunity, so please reach out to myself if you want to learn more about the deal, partnering with us, what that looks like for this deal specifically, but of course with Lone Star at a macro level. We're really excited about this deal. We think the structure and the value add nature of this, the value creation that we're going to do here really speaks for itself. So the webinar will be able to walk you through that. All of our information is in the portal, slide deck, the pitch deck, of course, underwriting, the whole nine, it is there. So if you have any questions pertaining to Grand Riviera, if you have a 1031 exchange coming up, if you're a passive investor, or if you're a capital allocator looking to find the best deal in the marketplace, this is it, at least in my opinion, of course. Humbly, but not so humbly, of course. And then next, of course, we are having our flagship conference in the One World Trade Center in September. It is actually condensed and consolidated to a 1.5 day event, really. There's day zero, which will have a very grandiose and fun pre-party for all those who are going to attend. And then Monday will be jam-packed, meat potatoes, Lone Star Capital style event with some of the best and brightest in the commercial real estate space. So if you're looking to go to a top flight event, please reach out to me as well, or Dasha, or just ir@lscre.com. We can take care of all the information there if you're looking to go to the best conference in the marketplace, of course, as well, in our opinion. And then what else do we have on the housekeeping here? Hiring an asset manager right now. I believe, who would be the person to go to in that one, Rob?
I'd say the ship has sailed. We've got a lot of great candidates. Kent and I just conducted 2 interviews, so we've got a
Oh,
great
wow.
batch. Got a great batch of people. And if people are interested in finding out more about the position, they can just reach out to us, and we can show them the select leaders job posting. But yeah, I mean, we've got so many good candidates. Might have to get 2.
Right, right, right. And also, we are really working on bumping up and ramping up our engagement. So if you don't subscribe to this channel, please subscribe. It literally costs you approximately $0 and will help us grow to get the word out there. If you think this information is valuable and it could be useful to someone who is interested in the same content that you're interested in and you haven't shared it yet, please, please, please send this video to them. But if you could also just comment and like the video, that also really does go a long way. We've actually noticed recently there's been a lot of likes, which is great. It seems as if some of the haters have left. So if you are a hater, hate watching, I'm just kind of kidding. But if you do dislike this content, but you watch it to spite, if you want to leave a comment saying you don't like my shirt today or you don't like Rob's incredible tie, leave the comment there. Or if you really like what we're doing, want to contribute, please let us know. Some of our buddies have been commenting and whatnot, so we appreciate that. But we are really looking to bump up engagement. So if you could share these videos, if you find it valuable, if you could like this, if you could comment and subscribe, it is all really, really useful. We are here doing this for the people because the people need to be informed with the best of commercial real estate information pertaining to multifamily real estate and just macroeconomics for commercial real estate at large. So if you like this information, please like, share, subscribe. You know the gig. I feel like a influencer now, so I'm officially have done my influence there. But if you could please do those things, we would greatly, greatly appreciate it. Did I miss anything on that housekeeping?
No, that's it's very robust.
Very good. Well, let's get into some of the episodes today. Well, actually, just Grand Riviera. I'm going to give this an ad one more time. You want to talk about that real quick? I'm sorry this is going to be shameless, but since this is a 506C, we might as well spam it out. So can you give the spiel? We just did a webinar.
We got to get our money's worth, and I'm looking forward to doing the webinar with you, which happened in the past. already. Yeah, I think it's going to be a great deal for us and our investors. It's actually going to be, interestingly enough, the first deal that we run ads on. So that's a cool new step in Lone Star's journey. A lot of groups run ads and it seems to work for them. So I imagine it'll work for us. And hopefully, the way I look at it is it's a long-term investment in the firm and a long-term investment in ourselves. And what I mean by that is it may be expensive up front to get the word out and to attract the investors that we want to attract. But I think that on the long-term basis is really important, that we actually end up with long-term investors that really want to work with us rather than just kind of, we call it the hot money or the here today, gone tomorrow money and whatnot. So I think it's definitely worthwhile to spend the money to kind of filter through and find those good connections, those long-term investors. Like you and I have discussed, we have investors who are now genuine friends, and it's just what an amazing life it would be if we had 10 of those or 100 of those friends / investors, not just from a business standpoint, but from how full and fun of a life we would have. So much, friends and things going on. So that's the journey that we're on, and I'm super excited. And this is just the next stepping stone on that journey.
Yeah, and to piggyback off that, we would love to have more investors there, and it seems as if we are, putting so much emphasis and attention on our, capital raising partners, capital allocators and whatnot. We put a lot of equity into that bucket, if you will, but throwing money into this bucket now is certainly the next iteration, and it kind of gets to a point where it's infinite returns if it's, X amount of cost to acquire the lead, and then we do maintain that and grow it. It's basically infinite returns after that, re-up of an investment. So the goal is to collect investors like this, to really focus on them, to give great service. I always say this, we want to give a $50 million check writer and a $50,000 check writer a top-notch first flight experience that's very passionate for someone like myself to deliver that. So it starts with everyone here. So if you do know someone that might be interested in investing, of course, send our information to them, reach out. We would really appreciate it. Excellent. So let's talk about cap rates. So there's kind of been a funny trend going in that I think a lot of people have started to say or catch notice, which is year one cap rate, which is very misleading because year one cap rate is after a year of ownership, not going in cap rate. Okay, so can you talk about some of the things that you've heard and seen when consulting and connecting with Brad pertaining to this subject?
Yeah, this is just a funny anecdote that we've noticed, and specifically in Dallas, because Dallas is just such a hot market. It's so competitive. Cap rates are back down into the fours in many circumstances in Dallas, and I'm sure this is true for the other top high-flying markets in the country, but it's almost like it would be so untoward for a broker to say that they are selling the deal for a 4.5 cap, because people know that rates are 6 and that a 4.5 cap doesn't make any sense. But that's just where the market is in many cases, and there's a scarcity premium. There's not a lot of product on the market, so for the right deal, there's a ton of bidders, and that excess equity is going to compress the cap rate. And so instead, the brokers are saying, okay, well, it's a 4.5 cap today, but on year one numbers, because obviously in the spreadsheet, everything goes up and to the right. So on year one, the cap rate's 5, or it's 5.5. I was actually just at the Newmark conference like we recorded last week when I was down there, and I was having lunch with this guy who covers the Sun Belt. He's an acquisitions guy, and I was sitting next to another acquisitions person, and she asked him, are you guys doing anything, like what cap rates are you seeing in Dallas? And he said, 5.5. And then I kind of think to myself, like, sheesh, what deals are you buying?
Yeah,
what cap rate?
My brokers suck. What's going on here? Yeah.
What cap rates are you buying? What deals are these? And then he's like, 5.5 on year one. Like more like, high 4s, low 5s going in, trailing, right? And that was kind of funny thing number one. And then not red flag, but funny thing number two was she asked him, are you guys doing anything with negative leverage? He said, nope, we have to have positive leverage. Negative leverage is a non-starter. Well, on a year one basis and based on our deep in the money interest rate cap. So it's like in the end, everyone's back to their old ways. Everyone's aggressive. Everyone's looking to buy deals. And I know that you wanted to speak about the Blackstone acquisition as well, which also is perhaps a sign of the times. But the
Well,
question is,
let's not get there yet because I have another kind of caveat to what you were just saying there as well. Which,
hmm
if you want to finish your thought, we'll go into
no,
the next caveat.
those are my thoughts there. Yeah, it's just kind of
Yeah,
a,
well,
yeah.
Yeah, well, the next caveat too is how everyone calculates cap rates. So just so I know, this is a maybe really frustrating to those who are very sophisticated, but for those who are maybe partially sophisticated or kind of know left from right, but are kind of just understanding how deals get pitched to you. How we calculate a cap rate is kind of the NOI that we see going in with our expenses and our numbers. Okay, that's how we calculate our cap rate, not the cap rate that the broker puts out there. And there's two distinct and different, sets of numbers to look at there. So, and this goes to, who you work with is super important. People say they're always conservative. That's, as Rob would say, hackney. We say, of course, so we'd like to think that we're conservative. Perhaps we are, perhaps we're not. It's all in the eye of the beholder, as you say. But how we calculate is different than other sponsors, right? Of course, this is, an imperfect science. If you gave the same deal to 10 different sponsors, you're going to get 10 different numbers. That's just the way the world works. Who is right, who's wrong, no one knows. Everyone is right and everyone's wrong. It's all about the, where you buy it and where you sell it at the back end and what you've done in between to really conduct the business plan and the life cycle of the deal. That's important, right? But going in cap rates and all of that, can you explain some stuff that you've seen in the marketplace that certainly made you scratch your head a bit? Because I've certainly seen some deals of late where the cap rates that people are saying don't make sense when you actually look at, what the numbers will be adjusted to and whatnot. And then, of course, this interesting caveat that you just shared just a second ago sheds further light on the discussion.
Yeah, I think the way that we underwrite cap rates is, I don't even want to say I think, I know that the way that we underwrite cap rates and present them is objectively correct. And most people do it the same way. So I don't want to paint us as a contrarian or a fringe, or that, we do it right and everyone else does it wrong. I would want to say that the vast majority of people do it correctly. It's especially when you talk about the more institutional space. Uh, I would think that people who are doing it differently are, in one way or another, I mean, you could say perhaps ignorant in some cases, but I would say more likely they're just being manipulative rather than ignorant. Uh, because it's irrefutable that the most accurate cap rate and reflection of how much income you're buying is and this is going to be general and we can get more specific, but it's the trailing revenue subtracted by pro forma expenses. And, it makes sense because you're not the seller, right? You are your own entity, and the way you're going to manage the property and your costs associated with managing the property are your own. And that's what's going to dictate your ability to generate net operating income and free cash flow from the investment. So that's the way it works. And if you do have, I mean, here's like a nuance of that, a couple nuances. On the revenue side, it's not quite as simple as just to say trailing revenue, because what does that mean? You have to be more specific. So classically, people will refer to the T12 or the trailing 12 months of revenue. But there's also some nuance there. You might want to talk about a trailing 3 months instead of trailing 12 months if there's noise in the data, right? But then again, you could also make the argument that that's manipulative, or you're kind of cherry picking the best of the data set to use a certain frame or like a shorter trailing period of time. So I think there's just smart ways and ways to take liberties, because obviously underwriting is an art, not just a science. So we'll look at maybe the other income on a trailing 12-month basis, and then we'll look at bad debt on a trailing 12-month basis, but we might look at vacancy on more of like a T3 basis, because vacancy is kind of a more recent thing, whereas bad debt, it's kind of noisier data, and you want more time to kind of really understand the true bad debt picture. And obviously you want to dig into delinquency and all that, but now we're talking about like really digging in. So I'm just kind of talking about the high level revenue side and how you could go about piecing that together. The nuance on the expense side is, and this is a little bit different than just simply underwriting a cap rate, is if you have a unique way to reduce expenses, that is, like, let's just say for the classic example is payroll efficiencies. Payroll efficiencies, you can make the very strong and obvious case that it creates operating efficiencies for you. And that is like I said, obvious in many circumstances. If you own two deals next to each other, let's just say, and then you can save on payroll by having, let's say, one maintenance person cover both properties instead of two maintenance people covering one per each, right? So that would be saving you money on an operating basis. But is that creating capitalized operational efficiency and capitalized value, right? Is it operational value or capitalized value? And when I say capitalized value, what I mean by that is, yes, you're increasing your NOI by having lower payroll, but is a buyer going to be willing to pay you a higher price for that higher NOI? And the question is, are they going to underwrite the same way you are, right? You might have your underwriting, but when it comes to selling, again, now the buyer and the buying market are going to underwrite your deal and decide what they think are fair expenses, and that's what they're going to decide what is fair to pay. So you always want to look and think, okay, what are the market rate expenses for this deal? Not just, well, hey, I'm operating the property at these numbers, and that's why you should pay me this price. That doesn't work.
Right, and that's really interesting how, everyone underwrites slightly different, and how, if the next buyer underwrites, if we can put something in here, we've got good economies of scale on our end. And even for something as granular as insurance, which has been a really big hot button there, we underwrite, a range when we get a deal. It might be $800 to $1,600 a door. We always put in the highest end for that range. And there doesn't do us any good to actually change the range to go from the high end to the low end when we underwrite to show our prospective investors that, because we know that when we simulate the deal on the back end, if a group does not have the same policy that we have, which very few do because we have so much portfolio exposure to Houston. Now we've got, $450 million or so after a recent acquisition there at Cortland Copperleaf. So considering all that there, Preserve at Copperleaf now I should say, consider that there, we are getting at the low end, but the next person who underwrites the deal is not going to likely get that same price. So we need to simulate as accurately as possible to show what the exit number look like to best convey value to the next individual. So it gets very in nitty-gritty and in the weeds there, and we don't really want to change it in real time. It's just some probably free cash flow we can get. But also the way the cookie will crumble oftentimes is, hey, we might be right here and wrong there, wrong here, right there. So it's really just not a one-size-fits-all solution here. As you said, it's art and science, and if something comes in better than expected, great, you kind of just put the feather in your cap and you keep it moving as opposed to adjusting on the fly. At least that's how we look at it, but of course everyone does things differently. So I just thought that was a nice little contribution there to really add to further your point. And then in addition to that, it's kind of funny, some equity people have asked, hey, what's this cap rate like compared to the other cap rates? And Texas is a non-disclosure state, so Rob, I'd love for you to just explain what that means specifically to this, but Texas is a non-disclosure state, and a lot of people have asked, hey, how does this cap rate compare to the other sales? And the answer is, well, it kind of depends. So do you want to kind of maybe break that down as well?
Yeah, well, Texas, like you said, is a non-disclosure state, which just simply means that sale prices are not public data. So it can be arguably more challenging to get sale comp data in Texas. But at the end of the day, brokers keep track of all that stuff. Obviously, that's their business, that's their job. So we're able to get sales comp data from the brokers that we work with, and I think that's fairly reliable. However, regardless of whether a state is a disclosure or non-disclosure state when it comes to sale price, it's very, very difficult to get true cap rate data when it comes to sales comps. Because like we just talked about, we literally just wrote a whole book on the differences in cap rates and how everyone underwrites them differently. So if you came to me and you said, hey, this is a X cap rate, it could mean something to me or it could mean almost nothing, right? It just kind of depends on the source. Like if our good friend JC Clemens tells me what the cap rate is, I know him and I speak the same language and vice versa. So when he calls me and asks for the cap rate, it means something to him. But unless you know somebody in the way that they underwrite, it doesn't really mean much. So if the brokers provide us a spreadsheet and they say, all right, here's all the sales comps and it was X price per unit and it's a 5.3 cap, it's like, I cannot do I certainly can't take that to the bank, and I really can't do almost anything with it. So the best cap rate data that you have is your own, because you underwrite your own way, and it just means something to us, and it's not really going to mean nearly as much to somebody else. So that's why it's really important, as we always preach, to be focused on a specific market where you can have a chance to underwrite a lot of the same deals or a lot of the deals in the same area so that you can actually know and understand the market and just really quickly understand, oh, wow, this is a 6.8 yield on cost or it's a 7.4% yield on cost. That looks really good.
In Austin, Texas, a 4 cap might look like a great deal. In Lubbock, a 4 cap might look moronic. So apples to apples is often hard to find if you don't have good internal data, as you just pointed out to, and you don't have a long historical track record of underwriting and bidding on deals, figuring out where you fall short and where you need to be to kind of thread that perfect needle to acquire the best investment and opportunity at the time. Another thing that's been really interesting as well on the equity side is a lot of equity people, very much so sophisticated folks, I would say, have been asking about, hey, do you have any trades or, I see the sales comps, but do you have anything more recent? And due to the lack of transactions that have happened in the market recently, it's been very challenging to send them or even show good numbers as to why this price makes sense or, why this is actually a really good buy, because there's just not that many, deals and opportunities that are coming to market right now, which, I think is really interesting. Of course, in 2021 and the first half of 2022 and probably the back half of 2020, very easy to say, hey, this deal makes sense because so many deals are trading, right? Well, in this period of time, it's kind of, not really that easy to decipher what, price makes sense, what looks good, using a comp from 2022, well, is that just different because cap rates were so compressed? Or 2023, hey, do you have more recent comps? And the answer for a lot of times is like for like, not particularly. It's been very challenging on our end to kind of show that. That's something that Brad and I kind of chuckle about and laugh about just because our hands are kind of tied due to the lack of trades.
Well, when the answer is least knowable, when people feel the least amount of certainty, is when the best deals are to be had. If everyone felt really good about the market and if everyone was super excited about investing, there would be a deluge of capital that would come in and it would just bid all the prices up and there would be no opportunity. And so it's kind of funny how you just see psychology play out in real time. These are smart people, right? Institutional money is stewarded by smart people, right? They are in private
Smart
equity.
people who subscribe to groupthink.
Unfortunately, no matter if you're smart or dumb, you are subject to groupthink, and it's really hard to break out of that and be contrarian. And so that's like to your point why people are saying, oh, well, I really need a sales comp to bang me over the head and to show me why I need my hand held to invest into this deal, right? But yeah, I don't think, unfortunately, you and I are able to crusade against human psychology. It just is what it is.
It doesn't, and also it's not our job to do that. Our job is to find the yeses, not the nos, and to not explain to people why now is a good time. I mean, sure, we should convey that and have conviction when we do kind of make that pitch and presentation, but it is not my job to tell people they're wrong and capitulate, or sorry, to complain and to, just give up. My job is to find the yeses, not the nos, right? And only we will know in a 5 to 10 years time who is right or wrong. But I look forward to buying in every part of the market because you just don't know what the bottom looks like. And if you buy well, you can make money at any point of the cycle should you put the right debt and equity structure together. Speaking of the right debt and equity structure being put together, perfect segue, might I add, to another subject that we were cackling about, which is, for those who don't know, cackling means we were laughing. Very much so. We've had this subject for a very long time, which is loan assumptions. So you and Ken, I think, were joking about this as well, perhaps yesterday, but I know you really wanted to make a mark here. Maybe you want to name drop a certain individual who you were alluding to on this front, but let's go and dive into this now.
Yeah, so it's just kind of a funny thing, and it speaks to maybe perhaps a bit more of the group think that people get wrapped up into. But over the last, I'd say almost now 2 years, some people have been raving about loan assumptions, and they're saying, oh, well, the best deals today are loan assumptions. If you can hunt and peck and find a deal with a great in-place loan, you found yourself a winner. And the reality is, first I'll say the reality and then I'll say the philosophy, because the reality is like everyone else, we look at every deal that comes onto the market and we looked at plenty of loan assumption deals. And guess what? When a loan assumption deal is being marketed to us, that's the headline. The headline is, oh, this is a 200 unit deal. It's a good location. It's whatever. Oh, and by the way, big headline, there's an in-place loan at 4% and it's assumable for the next, has 7 years left remaining, right? Well, ding, ding, ding. When we have been looking at those deals, we've been getting way outbid because a lot of capital focuses on those deals and gets poured in, and then those deals will get too thin and they get bid up because everyone's chasing that loan assumption, and it's like, what's the point of it, right? So the reality is, like the joke was when people are, it's like you pitch them a deal. It's like, hey, we just got this awesome deal under contract. Do you want to invest? It's got a 3.5% loan in place. Oh my gosh, how did you find this deal? That's incredible. It's like CBRE, Newmark, Berkadia, like everyone in the
Oh,
world
you
saw
saw a
this
deal
deal.
that everyone else bought or was looking at?
Yeah, everyone else in
Like
the world saw this.
I want to buy deals where it makes sense in today's debt, not get suckered in by some really sweet sticker price over here as to why, hey, this deal makes sense over here. But it's people are acting as if they're the only buyer in the marketplace. Like this isn't wickedly competitive, where and also like where you always say this, a free lunch. There's no free lunch in investing, not with institutional assets as well. So there's just such a misnomer, I think, pertaining to that. Yes, we would like to find a brand new construction deal that we could put a tax abatement on with maybe some loan assumption, if that's even possible, that there's no buyers for, and we're the only ones that can manage it, but there'll be a really great pool of buyers on the back end. Like that exists. Like these opportunities just grow on trees.
Well, they don't grow on trees, but they do exist to some extent, right? If you really hang in there and you really wait around for the right deals, that those really unique opportunities do come around. But unfortunately, everyone is pitching and wants to be pitched on why XYZ deal is the best deal ever, right? And the reality is, most deals are just singles and doubles, which is perfectly fine. You can do very, very well, successful as an investor as well as a sponsor by making your money on singles and doubles. Not every deal has to be this home run, amazing unicorn that you found, right? But to your point about no free lunch, it goes back to the seller as well. The seller's not oblivious to the inherent or intrinsic value associated with the loan that they're allowing you to assume. Furthermore, the broker that they've hired, that Newmark, Berkadia, CBRE, these are some of the biggest real estate companies in the world, and they're doing hundreds of transactions a month around the world. They're smart. They know what's going on in the market, so they're
They
not
have
going to
robust,
misprice.
yeah. They also have robust context books of every single buyer in town and prospective buyer, and so on and so forth.
Yeah, so they're not going to miss out and overlook the value. There's this. It's what we talked about this on the podcast last week about. True alpha is when you're able to create value that other people didn't see. It's not enough to create value. You have to create value that other people didn't see, right? So 10 buyers are looking at a deal and all of them see a value add deal where they can renovate the interiors, but maybe an 11th buyer sees the opportunity to take the 2 bedrooms and chop them and add a kitchen and turn them into 2 1-bedrooms and able to double the effective rent from that original 2-bedroom unit. That's the unique value that the other 10 buyers didn't see. The other 10 buyers were just going to renovate that single kitchen, right? That is unique value when you can actually really go above and beyond, or think of complex debt and equity structures or tax exemptions and things like that that we have done. So yeah, that's a little bit more thought there. But the loan assumption thing is funny, and on paper it makes sense and it's cool, and yes, you get to go in on positive leverage and better cash flow, but like we always say, price is permanent, financing is temporary.
Price and location is permanent. Okay, those are the two most important things. I don't want to get suckered in on a bad purchase price, where I can get maybe some enhanced cash flow to not get the best exit on the back end. I'm like to make things that makes. I like to buy deals that make sense today and the purchase price that makes sense today. That's my belief on the matter. Specifically pertaining to this. So I don't know. I just think it's challenging. I think you make your money on the buy and the management and the exit. That's not an original take, or the first one's ever said that. But a loan assumption just kind of can feel like I feel like often it's kind of a sucker play to get you in the door to get the alpha beaten out of the opportunity.
Yep.
Which segues greatly to just kind of the market, and we kind of talked about this, but people going in, us kind of buying in every market, and a big group that everyone may or may not have heard of, but Blackstone is going in on multifamily. I think they just bought a place for either one property for $10 billion or maybe a bundling of $10 billion, but the quote was, "We are planting the seed of future value and what we believe is a favorable time for deployment." And not waiting for rates to be cut. So a lot to unpack there. I'll let you rip it.
Yeah, this is kind of I mean, it's a good topic. I'm excited to talk about this, but it's almost stale at this point. Remember we talked about this with Jeremy Roll at Best Ever. That was a month ago or so, and I think there's multiple ways to interpret it. Blackstone is a sponsor, and they are investing on behalf of their investors, and just like us, they have a perverse incentive to put out capital regardless of whether it's a good deal or not. So that's something that all sponsors struggle with, whether they're a small private equity firm like us or the largest alternative investment manager in the world like Blackstone, right? That perverse incentive exists everywhere. So it's all about, as an investor, building relationships, working with people that you trust, and sticking by them through good times and bad. But specifically on this transaction, right, Blackstone's coming out with the feel-good sentiment and saying, oh, we think we're planting the seeds of future value and stuff like that. It's like, well, what about the fact that you're able to buy a REIT and take it private, and it's a $10 billion REIT, and you're able to charge a 1% acquisition fee on that. So you're able to pull in $10 million of revenue, boom, on one deal like that, and it's a pretty straightforward deal. You just buy a REIT. They paid way over the public share price. So this REIT was sitting there, and I forget the exact numbers, but this REIT is trading at $50 a share, and then they came in and took it private at like $70 a share. So, like, on paper, does that sound like a good deal if they paid whatever percent, 30% more than what the public market, and the public markets are the smartest minds in the world, right? That's a way more competitive game. That's the smartest capital in the world, and they thought it was worth $50 a share, and then Blackstone comes and pays $70 a share or whatever the math is. So I think there's kind of some nuances behind the scenes as far as the headline. And also, let's not forget that Blackstone has famously has done some very big deals at the peak, at the worst time. So they bought EQR.
Well, they're market agnostic, right?
Perhaps. I mean, I wouldn't say it's wrong of them to buy at the top of the market. I'm just saying, for them to call this, they're like calling this as the bottom. They're like, yeah, we're planting the seeds of future value. This is going to be a great buy in the future. I mean, they have to say that, right? They have to pitch every deal like it's a good deal. I'm not hating, but EQR they bought at the peak. They bought Hilton at the peak. There's some other stuff that they've done at the previous peak, and then they ended up holding on long enough and doing okay. But I think, for them to make this big move is probably more so a function of them being bottled up on the sidelines and just needing to put out capital. So then they found this big deal to do and put out a bunch of money, and deploying money into multifamily. This is a good idea. The other thing that I think is actually probably the most interesting thing, and is something that I haven't studied enough and that I actually do want to study a bit more, is supposedly right now there's a big discrepancy between public market valuations and private valuations for real estate, and let's say specifically multifamily. So if you look at and I'm just going to take this data at face value. I don't think this data is exactly correct, but the Newmark chief research officer guy at the conference last week was actually talking about this divergence or value discrepancy. So he was saying that if you take the implied cap rate of either of all public REITs or of a certain subset of REITs, he said that the implied cap rate was 6.2%, and that the cap rate for the last quarter of transactions in the private market was 5.2%. Right, and that's a huge difference. If you can click a button on Charles Schwab or Interactive Brokers and buy a REIT at a 6.2 cap, that seems like a way better deal than buying a hands-on private real estate deal for a 5.2 cap. So to me, I can understand why there's a divergence, but it doesn't, to me, this doesn't make a lot of sense. So I would be curious to understand, and here's my great call to action for all of our super smart listeners. Why do you think that there's this discrepancy, and what do you think are the causes?
Please leave a comment in the show on the YouTube here. Please leave a comment if you actually have a take on that. That'd be great.
Yeah, so I'd be curious. And something else that's very interesting is this is opposite of what is generally happening in the public and private markets. Because if we observe the public markets right now, the S&P 500 is up today, and the public markets are near all-time highs, while the private markets are down 15 to 40% in some cases. So a lot of deals that we've been looking at in Texas, multifamily deals that were purchased at the peak are worth perhaps almost 40% less. Whereas the stock market a year and a half ago, it had its quick dip, right? Because the stock market moves faster because it's
Very
publicly
fluid.
traded.
Very
Right.
fluid, yeah. I
So it
mean,
had its bear
tech's
market.
in a recession right now.
Yeah, but the Magnificent Seven, tech stocks have rebounded. So all the public stocks have rebounded. They're at all-time highs. So you've got this divergence in public markets where they're at all-time highs. Private real estate is still low and has not had a rebound much. I mean, cap rates have recompressed a little bit, but we're still down here. But then you've got this REIT situation where even though the stock market is at a high, the public REITs are at a discount to private, which there it makes sense why Blackstone took, I forget what the REIT is called. Sorry, I don't have all this information at my fingertips, but they took that REIT private, which makes sense because let's just say the math is right. They're able to take that REIT private. So let's say they bought the REIT for 6.2 cap. The reality is they didn't because they paid a premium to the public share price. So maybe instead of a 6.2 cap, they paid a 5.7 cap. Okay, so they paid a 5.7 cap. Then they take these assets private. So they delist the REIT. Now they own these assets in a private REIT structure. And then now they get to be valued in the private markets, which today the private markets value those assets at a 5.2 cap. So they've created a nice arbitrage for themselves. They bought a 5.7 and it's immediately just by changing the ownership structure, it's worth 5.2. So they've created $1 billion of value just overnight. But the problem is that's not cash flow. You can't eat that. That doesn't buy you your next Patek Philippe, right? How do you monetize that? Or Rolex. The way to do that would be to do a refi and capture that value at a higher appraised value for the refi, or to sell. If you were to take that REIT private and quickly sell all the assets, then that makes sense. So I think we're probably taking it a little too far to try to rationalize it. I think
Well, it's
at the end of the day,
actually
they're just trying to buy a deal and put some equity out.
That's really interesting you mentioned those figures because it's actually right in line with what James Ng actually said on the webinar, which I just listened for the second time over again, took some notes about, and we'll kind of dive into some of his comments there. And it's actually a lot of content we got to churn through from his always well put together information. No free ads, but a free ad here. James Ng is great. He's got his monthly webinar. He is awesome. Highly recommend it. Of course, our content is great, but we like to think that his content is maybe second best, of course, to ours. Humbly, of course, but not so humbly. But he mentioned that builders are looking to build at about a 6.2% on their cap rate, and they're looking to sell it or so at about a 5.1 or their return. So that's what they're looking to solve for there, which is essentially exactly in line to what you just described.
Yeah, but that's a completely different
Yeah.
world, right? Would you rather I mean, it's a little bit different, right? Because maybe we're just using obviously abstract numbers, but if Blackstone's able to capture a 50 basis point yield on cost spread by literally just shuffling paper, right? They just buy the REIT, take it private. Okay, now it's worth, so they created a 50 basis point spread. A developer has to buy the land, get it entitled, go vertical, lease it up, and all that time and cost to build it. Let's say they now own that newly developed property at a 6.2 cap, like you said, and then now they can sell it for a 5.2 or something, and they've created 100 basis points of development spread for themselves, which is pretty good.
Yeah.
But developers, in reality today are having a really hard time.
No, of course. He was basically saying, hey, they take that trade all day long, which obviously makes sense when you look at the math of it.
Yeah. I mean, that's what
Yeah.
they're looking for, definitely. But speaking of taking a REIT private, I think, are we in a position today to talk a little bit about, I think, so this is going to go live in like a week. So I think we're good to share a little bit more about the story of Cortland that continues.
Okay, yeah. Well, do we want to talk about what we just closed, or do we want to talk about what's around the corner? Psych, we can't talk around what's around the corner, but we can talk about what we just closed.
We can talk hypothetically about what's around the corner, but yes, let's
Okay.
let's go for it. So, as many of you know, we recently closed Cortland Copperleaf, which we've now renamed to Preserve at Copperleaf, which is our newest acquisition in Houston. It's a 240 unit, 2003 vintage deal. Really beautiful asset. Cortland owned the deal since 2018. They took really good care of it. They invested $6 million into the deal. The funny wrinkle about the deal there's really three awesome things about the deal that are going to make it a potential home run. And we can't really talk about all of them yet, but hopefully in a later podcast we can really share everything and really share the wins and have a nice celebration.
Yeah, well, if you want to learn really about the whole process, I don't think, publicly talking about this is the best idea. All the nitty-gritty details, I will let you talk about anything that you want to talk about because you probably know what's allowed to be said and not. So I'm going to defer that to you. But if you are looking to learn more about kind of the comprehensive structures and our ability to kind of do some very savvy and sophisticated things, for lack of better
Just
words.
leave it at that.
Yeah, exactly. Please reach out to myself. You know the email, but it's craig@lserie.com if you've got a 1031 exchange coming up, if you're a capital allocator, or if you're a passive investor looking for really, really fun, unique deals. We're the people. So reach out to me. Back to what you were saying.
Yeah, so with closing Cortland Copperleaf, the big complexity, the cool wrinkle there was that Cortland, like I said, owned it from 2018. They invested a lot of money into the property. They've done well with it. The wrinkle is they used to own the property in a private REIT structure. So it's a single asset, single REIT ownership structure, and that was to facilitate a foreign LP into the deal. And this created a challenge for Cortland on the sale because they found themselves really struggling to find a buyer that was desirous and capable of buying the property, but not buying the property, buying the REIT entity, and then converting that REIT ownership into real estate ownership, which is where we are perfectly suited because Kent is a tax attorney. Kent's super savvy and sophisticated. We also surround ourselves with a great team, so we have a great team of attorneys. Long story short, we were able to handle it. We were able to work through all the complexity, get the contract signed, work through the REIT due diligence, partner with different companies to purchase warranties and indemnities for the REIT, and then successfully close on the REIT acquisition, just like Blackstone did. And then a day later, we unwound the REIT structure, dissolved the REIT, and then now we own the real estate directly like a regular real estate deal. And what was really interesting is a couple of our attorneys in Kent were having a conversation and kind of a debate. And Kent was like, surely another buyer, well, I guess they were asking the question, like, could a less sophisticated buyer do this if they had good attorneys like you guys? And the attorney, I honestly can't believe this, but the attorney said no. Said, with our other clients, we've tried and it's failed. Like, this is really complicated stuff where you can't just have an attorney just explain it to you and go, okay, cool, now let's do it. It is really tough. So it's no exaggeration to say that Cortland has a very limited buyer pool. So this is a really awesome classic scenario of creating value by way of buying complexity and selling simplicity, because we're able to get a discount due to the limited buyer pool that Cortland is able to command for this transaction. We bought the complexity, but when we sell the property in 5 years' time, we're going to be selling just a simple real estate asset, and that's going to
maybe not so simple because the unique structures we're going to put on the deal.
Yes, of course. Nothing.
And if you want to learn more, email me.
Nothing is ever so simple, but yes, that's exactly right. I knew you were going to say that too. So, but that's kind of the idea of buying complexity and selling simplicity. And the thing that I love most about this story, and I will be talking about this on my own little solo pod next week as well.
So shout out to the solo pod. Also, listen to that weekly. Just for the full umbrella, we've got the flagship podcast here, Rob solo pod, and my interview pod. Perhaps will there be a Craig solo pod in the future? Let's hope.
I sure hope so. So, what I'm going to talk about on the solo pod and right now is literally the second that we closed Cortland Copperleaf, now called Preserve at Copperleaf, and successfully pulled off the REIT acquisition and everything. Basically Cortland sent us the contract on another deal that we've been wanting to purchase from them. So we proved ourselves that we were a good buyer. We did what we said we were going to do. We were good to work with, handled the complexity, and here we go. Our efforts are being rewarded right away with another opportunity to step up and purchase another REIT and unwind it into direct real estate ownership. So that's a really huge win. I can't think of a better story that's playing out here. So I'm really proud of the team and everything that we're working on right now.
Yeah, it's really great that we have the ability to do what very few can do and are willing to do. And it's even right now, it's funny, I had a note to talk about this as well, but the lack of transactions right now has really created cap rates to compress. If there's 10, 15 buyers on a property, guess what's going to happen to the price? Well, naturally, it's going to go up, and the number that you liked it originally to underwrite to will disappear. So we're kind of seeing that happening in real time. But if we can kind of buy properties like this, where we're not only the buyer of choice because there's very few who can do it, but there's also just not really the biggest buyer pool, we're actually getting these deals for numbers that we are very comfortable with, which is always hard to say. It is not often in the marketplace at any point. If the market's hot, if the market's really quiet like last year, are we ever going to find numbers and where we are right now? Are we ever going to find deals that we're very happy about with the price? But I have to say, we've been very fortunate with Aspire Apartments. We love that price. Cortland Copperleaf or Copperfield, Cortland Copperleaf, of course. That deal we just closed. We felt very comfortable with that price. We actually loved it. Grand Riviera would do. And then this newest acquisition that we got as well, that is far away, so don't email me just yet. You won't receive it. We feel really great about these numbers, which is a nice feeling.
Yeah. So all really cool and interestingly how that ties well into the Blackstone story.
Yeah, without a doubt. Well, do you have any thoughts on that there? Or should we transition to just some of the notes that I have kind of going through if you want to pull up some screenshots pertaining to the webinar that you and I both watched from Mr. Ang?
Yeah, sure. Let me share my screen here and let's do it.
Yeah, so I had a couple of thoughts here. If you just want to read through some of the highlights, and I can kind of break down what I found to be kind of interesting.
Okay, cool. Yeah, well, you just watched it again, so honestly, it feels like I saw it a while ago. So why don't you go ahead and kick it off?
Yeah, well, I think number one, think about, and this is kind of jumping out of order, but just rent versus own. So I know this is the second kind of graphic here, but the rent versus own thing is very interesting to me. It seems like before, I think the average person is buying a house maybe at 32, 35, kind of that range. Those numbers are actually trending now to being like 39, and I think as a 30, if you're kind of 30 now, by the time you're 39, that number is going to change and skew older as well too. So I think that discrepancy and that delta between renting and owning is only going to get wider, which is really beneficial to anyone who's in the apartment investing space, especially for existing property and kind of the workforce space. That will just kind of create a chokehold on just apartment kind of supply at a large level.
Yeah, it's a long-term demographic tailwind for multifamily. And like we've been talking about for a long time, it's never been more expensive to jump from renting to buying a house. And that's keeping a lot of people as renters. So just the realistic costs of homeownership, it's just slipping away. And this is just really unfortunate for the country, but it's just slipping away for the average person. And it will kind of perhaps forever be unattainable. So that's
Well, I also think, to piggyback off that too, we've had very much so conversations about this. I think you basically said, unless you're me, owning homes is kind of a silly thing. And I say me because, with obviously my extensive real estate background and residential, I can kind of find value. Of course, that's why Lone Star loves people like myself, because I can find value anywhere, of course, just like in our apartment investments. But no, on a serious note, I get the ability to kind of buy and sell a little bit easier as I'm licensed. But for a lot of people, the thought of owning is actually not even something that people want to do. And if you look at some math, in a lot of places, it doesn't even make sense to own. So you think a place like Florida or, New York or California now, right? So just where we grew up, you could rent for the same price as what the yearly annual property taxes, okay, on a place basically. How would it ever make sense if that's the case? So I think a lot of times owning is kind of, not going to say it's antiquated, but for a lot of people, that's not really their dreams or aspirations anymore, which is a great shift for folks like us who are in the apartment space and specifically that workforce space as well.
Right. Exactly right. So there's not just a change in affordability, there's also a change in culture, social
Mindset.
desire to own, mindset to own. Yeah, I mean, living in New York, right? There's no stigma associated with renting. I don't like hold my head down and think, oh gosh, I'm a loser because I'm a renter, right? But there are, um, there has been, and there still probably are communities around the country, and there have been periods of time where it was really like, hey, you graduate from college, you get a nice job, and you buy a house. And if you don't own a house, that's something to, you know, I guess maybe in a way be ashamed of, right? And it's like a mark of success. But I think, yes, tastes are changing, lifestyles are changing, people are, making those more family-oriented decisions later. So
Yeah, so
those are
right
all
here it
big
says
things.
2x more expensive to own versus rent. Well, why is that? Well, the average home price, as everyone knows from COVID, from rates getting artificially suppressed to, where you could lock in, sub 3% interest rates, a lot of those people aren't selling their house anymore because A, their basis is so great on that, their debt is so cheap, it makes no sense to not. They're living in a place that might have their mortgage be 2 grand a month, where if they were to buy basically that same like for like property or maybe try to trade up, their mortgage could be 38 to 4,500 bucks a month. I mean, that is on your your overall cost of your day-to-day living, that's incredibly high. Where would it even make sense to make that trade when you could just rent it out potentially? So I think there's going to be a lot of people who are just kind of forced owners because the cost to sell is too high. And if you're refinancing right now as a homeowner, it's probably to pay off bad debt, credit card debt, car payments, things of that nature.
Yeah, and the other thing that I find really fascinating and think about a lot is the fact that the American dream being post World War II in the 50s and 60s of a white picket fence and owning your house and having 2.1 kids and being able to graduate from high school and be a mechanic and being able to own
Work in
a
a
home.
factory.
Yeah, work in a
Yeah, work
factory, own a
have
home, buy a
two
car.
cars, vacation, comfort. Those days are long gone, unfortunately, and that also probably is going to affect one way or another. People having children, even because if people can't afford really their day to day and they're already in debt to start with, why would they bring a child into the world, right? That's kind of a kind of an issue and concern there.
Well, now you're just getting me depressed, but yeah, so the phenomenon of post World War II American supremacy, American exceptionalism, the halcyon days, a lot of people look at that period of time and they go, look at that. We need to get back to that. That was when things worked. That was when things were normal. And that was when we had a middle class. And unfortunately, I would say history more so points to that being an aberrational time, meaning it was an anomaly. That's not normal. That's, if you
Well, we
look,
had a consolidation of the GDP nationwide. Sorry to cut you off. I know I never do that right. But you look at the world, GDP and what America was contributing to it, the disproportionate amount of economic output that we were doing in relation to the world was the largest delta there'll probably ever be, maybe in human history on Earth.
yeah, it was 30%. So, so that was an aberration. And if you look at thousands of years of history, it's just been a few people at the top that have all the wealth and all the power, and then you have serfdom, right? And that's not a pleasant thing to think about, but that's kind of the unfortunate reality of human history. And I think right now, and if you want to put your conspiracy theory hat, I think the people in power right now are pushing. I think it's naturally happening, but I also think that they're pushing for a reversion to the mean, and the mean being a few people at the top who have all the wealth and consolidated power, and then a lot of poor people. So I know we've kind of gone off the rails, but obviously this does naturally tie to workforce housing and multifamily, and
And
the
why you should
fact
be investing with us with
exactly
affordable
you
structures.
want to be
Yeah.
at the very top with all the wealth and power, right? But
Yeah. You want to be a
the
smart man.
the part the part about that, right, is you have way more renters than homeowners. Home ownership in this country peaked at, I think, 63% or something in 2006 or 7, and I don't think we'll ever get back to that again. Europe has led the way. Europe is 20 years ahead of us in this trend. And also, if you observe home prices around the world, home ownership was like a unique American phenomenon where, like, if you look at France, or like specifically Paris and Moscow and a bunch of other cities around the world, you'll see that their home prices relative to annual median household incomes, it's way higher. So homeownership is like way unattainable, way more expensive in a lot of places that we don't really realize and take for granted. Like the Netherlands, for example, the Netherlands has the most wealth inequality in the world, and that's in part due to taxes, in part due to legacy stuff. But you know, buying into the asset and the wealth class is almost impossible because the assets are way up here, they're worth way up here, and your income's way down here. You can
Well,
never break into it.
and the interesting thing too is you want to talk about bad cap rates. You could buy a place there, but the cap rate is heinous. So, it's just a very interesting and cool vehicle that we get in America, which is obviously real estate investment. But I actually learned this term not too long ago. Do you know what the word mortgage means?
Yeah, I can't remember. Yeah, tell
Yeah.
everybody.
Yeah, so mortgage is a French word, okay? So I'm reading right now Google, it's death pledge. The word comes from an old French mortgage, literally death pledge, from mort, death, engage, pledge. According to the online etymology dictionary, it is so called because the deal dies when the debt is paid or when payment fails.
Makes sense. Makes perfect sense. And I think
So
even if debt is non-recourse, you should think about it that way as well.
yeah. Another thing to think about as well, specifically pertaining to just this whole macro idea. Tony Robbins, I think I sent you that reel the other night, and I don't know if this is real or not. Sometimes you get on this and that, but it was just kind of talking about $1 million. If you got $1 million in your account, you put it into the S&P 35 years ago, I think is what it was. That $1 million in the S&P 500 by just doing nothing would be now $26 million in today's dollars. But if you put that same $1 million in average private equity, it'd be something like 130 million or so. So it's just kind of crazy. So it just goes to show if you work with groups like us, not saying we're going to turn your million into, over 100 million over a 35-year life cycle, but what I am saying is that the amount of, hands your dollars touch in, the typical, public markets is a lot. So there's a lot of kind of eating away at that, as opposed to if you work with a group like us, there's less touching of that. It's more direct.
Yeah, it's true. And historically speaking, I think you can make the argument, and Tony Robbins I'm sure he's behind that, pitching some sort of private equity play that he wants people to
Yeah, and
invest
that's
with.
why I'm not trying to hammer this home as if that is law and Bible and should be studied precisely, but it was just an interesting kind of thought, and I want to share it with you because I'd be curious to hear your kind of perspective.
Yeah, I mean, private equity has done super well. It's a new industry, relatively speaking. Private equity was kind of in its present form invented in the 80s, so it's still a really new thing. And back in the 80s, since it was all brand new, valuations were really uncompressed. There was very little competition, and companies were just a lot less sophisticated. So you could go around, buy a deal, and then raise the revenue of the deal substantially, and then expand the multiple. And private equity, there you go, you're making a ton of money. I mean, the world is now just so much more competitive. Yields are more compressed. It's harder to make returns. So private equity is really ballooned into, I mean, genuinely an institutional asset class that rivals public equity. So I don't think there's necessarily like, oh, stocks are bad, private equity good. All right, it's all kind of the same. It's all the same bucket of interest rate speculation. However, when it comes to real estate, I do think there's just a legitimate differentiator for private real estate ownership over everything else when it comes to individuals and U.S. taxpayers, because of the dramatic tax benefits associated with private real estate ownership, depreciation, and everything like that. So I think that's just the super cheat code. And as a U.S. individual, you just cannot beat private real estate investing on a post-tax basis when you compare it against private equity or VC or public equities.
Absolutely. Well, we are at about the hour limit, which is where our listeners start to tap out. So for those who have been listening to the show so far, thank you so much. If you want to hit that subscribe button, please do so. If you want to hit that like button, we would really appreciate you. And if you want me to really love you, please leave a comment. Good, bad, the ugly, put it there so we can get better. We'd really appreciate y'all doing that. Rob, I think I cut you off about more than I have in this show over the last 5 weeks, so for that I do apologize. I'm a little bit excited right now. This episode got me juiced up, and I'm just fired about all the great stuff that we are doing right now at Lone Star Capital. And if you want to learn more about all the incredible, fun, sophisticated, smart, intelligent things that we're doing at the firm, reach out to me. You know the email. I'm going to say it to you once more. It's craig@lscre.com. And if you're looking to learn more about Grand Riviera, if you're a capital allocator or passive investor wanting to learn more about this opportunity and work with Lone Star, please reach out to me. We've got our conference coming up once more in September. Please let me know if you can make out to that. It's an application process, so if you want to put in there you heard us from the podcast, that might get your admission accepted quicker to go to the event. Similarly, Grand Riviera, it's an incredible deal. We still have a little bitty space of equity there. The webinar is out now. I think Weston should have that video out and about and ready to surface as well. So if you want to see the property, we were there, of course, just 2 weeks ago. If you want to learn more about that opportunity, watch that video. That will give you a really nice comprehensive look into the deal and as to why it's a great deal. Rob, any final words you've got here?
No, I think I'll take the interruptions with the enthusiasm, and it was a good show.
Yeah, well, we're always trying to get better. I got to self-scout myself, as Chris Sims, the former quarterback who got his spleen removed, always says, self-scout thyself. With that said, thank you so much for listening, and we'll catch you next week. Peace.